welcome to Personal Finance. I'm Gugulethu Cele. Once again, we come to you from the Discovery Financial Planning Summit for 2015 being held at the Sandton Convention Centre. Now, today we're going to tackle the topic regarding tax and the key considerations you need to bear in mind as to how tax can impact the growth that you see on your investments. To tell us more about this topic, I'm joined by Marius de Waal. He's an agent for Discovery as well as a certified financial planner. And we're also joined by Sharfman. He is from NFP Insurance Solutions based in the US. Gentlemen, thank you so much for joining us today. Maybe let's start off with you, Marius, to give us more perspective on the landscape regarding tax and investments. Everybody thinks of tax as one of those unnecessary payments that you have to make, but clearly it's something that everyone needs to embrace.
Correct. You can never get away from tax. But I think when you're busy with the financial planning of a client, it's very important to look at the different impacts of different taxes on different products. Because we're basically sitting with three different products. The one is endowments, which has been taxed differently. The endowments, and then we've got the list-linked investment services platforms, which is also been taxed differently. So when you do an investment, you need to look at the tax implications of the client, his personal tax portfolio, his total portfolio, and then according to that, you need to decide which of the investments will be the best for him.
And I take it this is obviously unique not only to the individual's needs, that assessment that you do in the beginning, but also the geographical locations, Howard, which will differ from South Africa's tax regime, especially what you've got compared to what you've got in the US.
Yes, when an individual sells an investment in the United States, they either pay a long-term or short-term capital gains tax. So it depends on how long someone holds the investment. If they hold it for a year or longer, it would be considered long-term capital gains, and that rate would be lower. But there are products such as annuities that are tax-deferred in their growth, and then life insurance that is tax-deferred in their growth and eventually tax-free in the payment of a death benefit.
Are we finding that there's a lot of incentives for people to invest in particular products and then get a tax deduction, or like you said in the US perspective where you get a deference on the date there?
Sure, absolutely. If we look at the costs associated with a product in exchange for the taxes that would be paid if you didn't have that product. So for example, in simple math, if someone could earn 10% on an investment and they're paying 30% tax to the United States government, that would be 300 basis points or 3% in tax. If there are products out in the marketplace that you could use that may have 100 basis points or 1% of tax, 1% of cost, but you wouldn't have to pay the 3% tax, you could create 200 basis points of what we would call structural alpha.
Marius, in your opinion? The South African environment, I take it, is slightly similar, where there are those
it's
incentives
similar.
that are
Obviously,
provided.
you always want to outperform inflation because you want real growth. And like an endowment, we're similar. We're getting a 30% tax, which is through the full fund tax approach. But on a LISP investment, there's only 15% dividend tax on the dividends declared through the investment. So your whole tax situation is 3% compared to 30%. We also got now launched recently that tax-free investment where the client can either have 2,500 Rand per month or maximum of 30,000 per year to up to 16.6 years, so you can get up to 500,000 tax-free investment, which is a very nice new product on the market for the individual.
That's new to the South African market, but does it mean that tax-free savings options are always the best option in trying to avoid tax payments on investments?
Correct.
You can come in here, Howard.
So you have to look at the efficiency of the investment and make sure that your investment classes match up with what your risk tolerance is. So once you have your risk tolerance, once you understand where your allocation should be, we look at allocation not only as a flat model, but three-dimensional. So clients have taxable investments, tax-free investment, and tax-deferred investment. And it's like putting together a puzzle to make sure at the end of the day, it doesn't matter how much tax you pay. It matters if you could retire comfortably or not. So the key is keeping your eye on the finish line of retirement and making sure you're most efficient. You've paid a reasonable amount of fees and you've paid a reasonable amount of tax, but at the end of the day, you could get there and you could retire comfortably, and then it all works.
And then obviously you want to minimize the tax when you retire. So your post-retirement income needs to be structured that you pay as least tax as possible.
How do you do that as an advisor? Is it choosing the right products then? Is it the
It's
benefits
the products,
that maybe
it's
just
the whole
thrown in?
scenario of every client is unique. There's no easy way going forward. You know, every pro's got different investments, they've got different income, different assets. So everything plays a role once he goes into retirement.
And the balance between tax avoidance and tax evasion, how difficult is it to manage a relationship with a client who doesn't give you full disclosure of the investments or other income streams that they have, and where they might be using that to try to avoid or even evade tax, Marius?
If they disclose that during the first discussions, then obviously you need to warn them about these tax avoidances or any of those problem areas, and then preferably try to move those products into a legal environment rather than picking up problems at a later stage.
And on your side as the advisor, are you guaranteed of not being responsible for any liability on that front?
Well, if we're not aware of anything, I don't think we can be responsible for those sort of things.
Howard, maybe if you can come in here with your experience.
The Internal Revenue Service of the United States has developed systems to find assets, track assets, and it's continuously evolving. So I can't see too many cases where someone who has a job and has an earned income and then also has interest or dividends, growth and stock appreciation would be able to avoid taxes. There's the reporting from the banks and the wirehouses, the brokerage firms are such that there are matching from not only 1099s but K1s. So we don't see that very often at all. But we do look and make sure that people have the appropriate assets based on the risk they're willing to take and the appropriate investments based on their goals and the risk, and we're putting enough money in there to retire. So at the end of the day, we're looking at compound money. We're looking if we could compound money without tax. It compounds faster than with tax. So we're trying to be as efficient as possible.
You mentioned compound growth. That's what everybody wants from the investments, and inflation beating that you alluded to, Marius. Maybe walk us through the necessary steps to make sure that the earnings or the growth that you receive on your investments isn't necessarily eaten away and reduced by the effect of tax.
You know, when structuring your investment, I think the biggest, the most important aspect is that you choose the correct different funds to compile the basket. You need to have a weighted average where there's not too much risk or not too little risk, because the lower the risk, the lower returns usually in the long term, and vice versa. So you need to look at the term of the investment, which is very important. The longer the term, the higher you can expect the returns. But on small terms, it's very difficult to outperform inflation. So you need to be very cautious when doing investments.
Cautious approach when doing investments. I'd like us to walk us through some of your own client experiences that you've had where, you know, sometimes the tax practices went according to plan and maybe other extremes where it didn't work out so favorably. Marius, we can start with you.
I think we all sat with the 2008 crash, which the moment things starts going down, the returns are going down, the client starts panicking, and that's the most difficult job of a financial planner, is to tell them to sit quiet, let this thing roll out, and it will pick up again, and they all start panicking. Then they want to move it into the money market, but it's too late then, you cannot pick it up again. And that's always the biggest problem we sit with.
Did you have the same experience, Howard?
Typically, success is based on asset allocation, and that asset allocation shouldn't change because the market moves up and down one day. We've had a larger problem with interest rates going down over the last decade, and our clients who live on fixed income, their rates have gone down, their income has gone down, has caused significant problems. By forcing interest rates down in monetary policy, we forced people into more risky investments, and right now that looks to be a very good thing, but we have concern that there's too much risk in the marketplace right now for our clients who are aging and they're historically have gone into a more fixed income environment, and thus their risk would be down. The same thing happened with insurance policies. When insurance policies were purchased, when interest rates were at 7 and 6% on a fixed level, and now they're at 5 and 4%, they haven't performed as well. They may have performed very well in comparison to the market, but comparison to the original projection, things have gone down, and it's very important that we continue to analyze that, continue to look at it, service the client, and make sure we know how much money we have to put into insurance policies to make sure they're there for us.
Just to wrap things up in conclusion, the key takeaway points that the viewers watching tonight needs to take into consideration when it comes to understanding the tax implications on their investments. Howard, let's start with you.
I think a key would be make sure the tax tail doesn't wag the dog. You want to be as efficient as possible in your investing, but you can't invest in a poor investment just because it's tax efficient. So you have to look at both the quality of the investment and the taxability of the investment, and you have to weigh both of those things.
Marius?
I think also very important is look at your financial planner and make sure he's qualified to render professional advice. Because at the end of the day, it's not him who's going to have the poor results. You're going to sit with those poor results at the end.
Lots to consider and managing that relationship quite clearly. Thank you so much for your time today, gentlemen.
Thank you.
Much appreciated. Well, we got that there quite clearly, the key lessons to consider when it comes to understanding tax and the implications it has on your investments. A big thank you to both my guests, Marius de Waal, who is an agent for Discovery and a certified financial planner, and Howard Sharfman, who is with NFP Insurance Solutions based in the United States. Continue to get in touch with us. You can use the hashtag Finance410 and get in touch with us on @CNBC Africa, or alternatively sending us an email on the details on screen. But from myself and the team, it's goodbye for now.